to take the next 21 minutes or so, and I want to talk about a strategy called Be the Bank. And then we're going to take a 15-minute break, and we're going to bring in the financing source that we talked about yesterday. Tell me that's not got to excite you. The financing source, right? We're going to bring her in, correct? Her. And she's going to talk about the terms and how she's going to assess you. She makes loans to Canadians and that type of thing. So I don't think you want to miss that. I just want to give you a heads up on what the schedule is. So the last topic, and we're going to talk about subject twos this afternoon in detail, but the last topic is where I'd like you to think about being the bank, or be the bank. And the basic strategy here is a little bit different. It's counterintuitive to what you probably are thinking. And it goes like this, in one of two ways, by the way. Provide a seller financing program which will allow buyers who cannot qualify for conventional bank loans to live in the American dream by becoming homeowners. Now you may think, what are we talking about here? We're Canadians, we're down here in Vegas. John is talking about some program called Be the Bank. Well, bear with me here. There's two ways that I want to explain this to you, which I think you will enjoy. I know you will enjoy it. And it goes like this. Step one, I want you to think about the financing aspect. This is two ways. Now, this is if you didn't have the credit, or maybe the person coming in didn't have the credit. They or you are going to find out your credit score. If your FICO score is over 700, you should be able to get a stated income loan if needed. Now, stated income loans are finally starting to come back a little bit. They're probably not going to come back in the droves that they were. What is a stated income loan? That's almost what we used to call a no-doc loan. You stated your income. And for a few years, it's been completely gone. I have seen them start to come back a little bit. So the financing side of the world is thawing out a little bit. Or you use RRSP money to fund the house. We often talk about how we become a real estate investor, and we take real estate funds, we buy the house or the apartment building, but we've got to manage it. We've got to find tenants for it. We've got to do maintenance on it. And what I'm thinking about is how we get a loan. I just put a couple different loans on here. Some of these are a little bit harder to get, but just bear with the overall thought here. How we actually be the bank instead of be the investor. And by being the bank, aren't we really the investor in the first place? So this might be a nice avenue for some of you to go. You get a loan, non-owner occupied, an option arm, or something, and tell all the prospective lenders, maybe your credit score, have them base their offers on the score you provide, what type of terms they're giving you. Do not let lenders pull your credit until the actual loan is going through the approval process. What am I talking about here? Well, let's just say that in one of these examples, you are going to find somebody that needs a loan for a house. You're actually going to qualify for the loan, have the loan in your name, and you're going to have that tenant move in that house, and you're going to act as the bank for them, creating what we just talked about yesterday, a wraparound mortgage. A wraparound mortgage. Same scenario, same idea, all of this. That's one way you could go with this. Or you create the second way. And, you create the second way, which is, did I skip a slide here? Which is, that's okay. You take something like RRSP money and you finance a house for somebody. You become the bank. And you might think, why would I become the bank? In every deal, isn't the bank also an investor when they finance a deal? Well, sure they are. Well, do we often have times where, our RSP money is not performing as well as it should. I mean, we see those statements and it's not as robust as we want it to be. Well, think about a bank and think about this particular environment here in the States. You might have a scenario where you've noticed that a lot of people are moving towards the rental side of the market. Why is that?
Can't go to the bank to get financed.
They can't qualify for a loan. They can't get qualified. Their credit is too low. I put that 700 credit score up there is because that is where the benchmark is for subprime. It used to be 680, but it's increased to 700. It's harder for people to get qualified for loans. People have the down payment, but they can't get the credit right now. So they need some time for their credit to build up. You might be able to take and put together a 3-year program. Well, you will go in and buy the house or put the financing on the house. You're going to put a mortgage together, a promissory note together. You're going to require 10% or 20% down. And that's the thing I've noticed too. People have the money, but they may not have the credit. Those are the people that you want. So let's say that we're talking about a $70,000 home. You're going to require in your program, I got to switch screens. You're going to require in your program, now I'm making this up on the fly, adjust it to what is appropriate for you. But you're going to require 20% down. So how much is that? $14,000. You might say, John, that's too much in the market I'm investing. I'm only going to require 10% down. But you require 14% down. Where does that 14 go to, by the way? You've put the 70 in. You already own the house, or you're putting the mortgage in on the house for 70. Does everybody see that? But you're going to require 20% down. So immediately you're getting 14% back. Or 14,000 back, I'm sorry. You've still got a loan on the property for how much? $56,000. Does everybody see that? So that's what your mortgage amount is going to be. So 14 down payment, mortgage for $56,000. That you own the mortgage. You own the mortgage. The terms on this, what does your RSP typically pay you annually? On average, give me a number. 5? Minus 1? Yeah. Okay. Why not say, okay, I'm going to mortgage on this, and I'm going to charge, this is our program, I'm going to charge 12%. Immediately, your RSP money is charging 12%. You're earning 12% on that money. Now, you need to talk with your fund manager with that. But that money may be able to go right back into that RRSP, or RSP for short, program. Just like here in our self-directed IRAs. You invest with that money, and as long as you want to keep that in that program, anything that you get back, like the 12% interest on that money, needs to go right back into that program to be completely insulated from that. I believe that works the same way with RSP, correct? It doesn't?
I think it has to be an eligible program.
Managed.
So this wouldn't work? Then I digress. I was thinking creatively last night and I put this together, so you've just ruined my whole program. Great. Let's say that you have this money in savings. Now it works. You get the point I'm trying to make. You can get a 12% return on that money when you institute a program like Be the Bank. How about this? Then let's switch gears. Fine, you threw a curveball at me, I'll throw one right back. How about this? A lot of you have home equity line of credit that you pay what on? How much? 3%? Now you've just taken that money, that same money, and you're earning 12 on it. So you keep the 9% spread. Is that better? Yeah. Okay. So, being the bank still applies to you. I think this would be a great way that you work that spread and you can make a nice bit of income from this. How many times can you get a 9% return on that money? That's pretty good. That's pretty good. The other thing I would mention is you've got to be cognizant of your risks in this program. Your risk is just like the risk of the bank. If that homeowner doesn't pay the mortgage to you, what do? You're going to have to foreclose. You're going to have to foreclose. So there's some things to think about. There's some risks there, but if I think about banks, I'm often thinking about how much money they earn. How much money they earn. Because, let me switch the screen here. Because if you act like a bank, there's fees. There's an application fee. There's probably a loan origination fee, perhaps. There's a down payment. There's interest. There's possibly a prepayment penalty with your mortgage. If they pay that before the 3 years is up, it's 1% of the loan or 2% of the loan. Banks do it. Why wouldn't you do that? Institute a high interest rate. There are people looking for loans. You're a perfect example of that with the woman that we have coming in next. I believe she's charging what, 12.5%?
Yes.
12.5%. So, I would advise you to charge a heavier interest rate, such as 12%. Principal and interest, by the way. Principal and interest, so you want that principal pay down over time. I would always, if you're going to institute a program like that, recommend escrowing taxes and insurance. So their payment is going to be principal, interest, taxes, and insurance. Why do I recommend that?
To make sure it's covered.
Yeah, to make sure things like those taxes and the insurance gets covered, okay? To make sure the taxes and insurance gets covered, I recommend getting that paid through a servicing company. A servicing company will take care of all those payments and distribute them accordingly. And from there you can institute other programs. You're going to create, say, an LLC or an entity that is going to be your quote-unquote person that's holding, or entity that's holding the mortgage there, okay? Now, I don't think you want to call yourself a bank or officially get into that business because you're going to have to be licensed or chartered as such, federally or statewide wise. But this is definitely a program that you could get into on your own. Have your LLC put a mortgage together and provide a mortgage to somebody that wants to move into that house. Charge a higher interest rate, and if you're borrowing money from a home equity line that you're paying 3% on, work the spread. That's exactly what a bank does. When you deposit money in a bank, now besides the fact that they can lend that out, 6 to 20 times their deposits, they're working on a spread. They're paying you an interest rate of 3, but they're lending it out at an interest rate of 6, kind of thing. All I'm having you do is mimic that same procedure. Yes?
In what scenario, so obviously if you're doing this, you're giving up the 3 shuns, right? So in what scenario would you use this over traditionally just holding it?
I would use this scenario. That's right, I was doing that yesterday. I was telling you if this would be no cash or some cash. This would be if you have access to cash, but you don't want to be a property manager. You don't want to have to get, the tenants. This would be a great program for a hands-free scenario where you're not that involved in toilets, tenants, and termites, so to speak. Does that make sense? So this would be a great approach for hands-free. Take a home equity loan, you're paying 3% interest on it, you put this program in place, you're getting 12, you require a down payment, you make sure you run credit, you make sure the homeowner's viable, and you go from there.